Alrighty, good morning, everybody. I hope you are all doing amazing. Welcome to our session. Today we are going over tax strategies with Miss Sandria Goodall once again. Sandria, I'm going to ask that you just do a very brief introduction for your bio as I couldn't pull it up over here.
Right. Well, thank you so much. So, as Aaliyah was mentioning, my name is Sandria Goodall, and I am the owner of allgoodaccounting.com. We provide accounting and tax services, creative alternative solutions that is guaranteed to save you money. And I'm really happy to be here. I look forward to sharing my knowledge with all of you, and I hope that it will make a difference in terms of saving you all money going forward. That's a little bit about me. So, yeah, Aaliyah, you can go ahead.
Thank you, Sandria. As for myself, I will be your facilitator for today. My name is Aaliyah. I am the owner of InnovaK, which is a business that focuses on freelance paralegal services and also business development services. So if you guys ever have questions, I'm also here as well. As for this show, we're going to get the ball rolling. If you guys have any questions, please feel free. This is a fully interactive session. We are asking that you guys throw your questions in there. If you feel like you need to come off mute because maybe you're not good at writing questions, or maybe the question's going to fly away, then feel free to come off mute and politely interrupt to ask that question. Otherwise, we'll watch the chat to keep up and see if we can answer everybody's questions.
Sure. Sure.
All right.
Thank you. Thank you once again. And yeah, it's busy. It's tax season right now. We're just finished the personal side, and now we're getting into the business side of things. And the deadline is coming up for that as well. Just something to note for those of us who do have businesses. The main thing is June 15th is the deadline. And the idea is you file your taxes by then. That's for small businesses. I'm not really relating to corporations because corporations have different year ends. But if you're one of those small businesses, June 17th actually this year would be the deadline. And also, if you do owe money, the thing is to file now, because after April 30th, even if you file by June 15th, you will be penalized. So make sure if you owe money or you think you're going to owe money, file now. All right, so with that being said, I'm about to share my screen and start the presentation. So today my presentation is about tax loopholes, okay? And there are many of them within the business world. And so I will be highlighting a few of those today. So for those of us who have the business, have the small corporation, this is for you. All right. So one of the things I start off with is, first of all, highlighting, those of us who are about to start business, those of us who are in business, to be aware of what we call avoiding personal service businesses. Okay. What is a personal service business? Well, it's when an employee resigns from a company, sets up a corporation, and signs a contract with the company, provides service as an independent contractor, the same service they used to provide as an employee. So here I am as an employee. I decide that, hey, you know what? I want to go in business for myself. I resign, start up a company, and then go back and provide the service as a corporation. The CRA frowns upon that, and if they have found out that that is if that's the what ends up happening is that they will actually remove you from the corporate tax bracket and charge you at the highest tax rate of 33%, which is similar to that of the income tax bracket rate. So you want to make sure you make a clear distinction between a business relationship and an employee-employer relationship. And how that is done, there are certain things to look at and to look into around that where CRA is concerned. So I am just basically going to go through some of the questions that they ask and what you need to look into when you are embarking on this journey of becoming a self-employed independent contractor. And if the answer is you most of the time, then you are independent contractor. If it's the employer for most of the answers in when we look at them, then you are an employee. So let's go through some of these questions. So what CRA looks at to determine the following is one, whether you are required to work a certain number of hours a day. So if that depends upon you, then you are a subcontractor. If it depends on who you're working for, then you are an employee. They also look at how much control does your contractor have over the work you do. Again, if that's more on your end, then you're a subcontractor. If it's on their end, what you do and what you do not do, then you're more so an employee. Who supplies the tools and office that you use? Again, if that's you, then you're more a subcontractor. If it's the employer, then of course you are the employee. Whether you work for services, whether you invoice for services rendered, okay? Again, if it's you, subcontractor, if not, employee. Who carries the risk of business loss? That is you, subcontractor, not you, employer. Who has the opportunity for additional profit? Would that be you or not you? Whether you provide services to more than one source, is that you or not you? Again, you want to differentiate that. And last, whether you have the flexibility to determine your schedule. If that is you, then you are a subcontractor. If not you, then you are an employee. So it's very important to distinguish what are you and how are you performing. So in this presentation, we'll be focusing on being an independent contractor. It is more advantageous to arrange your business relationship so that you are an independent contractor rather than an employee to maximize the allowable deduction for self-employment. Again, as Aaliyah mentioned, if there are any questions, feel free to ask. I'm not able to see people at this point, but I'm sure if Aaliyah, there are any questions, you will let me know. Now, before we jump into all the tax loopholes that are there for us, we want to make sure we're clear of the type of business that we're in. And so there's 3 specific kinds of business that are the most popular ones in Canada. And so we want to highlight some advantages and disadvantages of them. First, we've got the sole proprietor. And the advantage towards being a sole proprietor is that first, it's easy to start. I could get up today and say, hey, I'm a sole proprietor. And so long as I operate in my name, then I don't need to register. And hence, we've got low registration costs. And myself as a business owner gets to make all the business decisions, right? And so those are some advantages, and there's a lot more, but I'm highlighting those 3 for now. Some disadvantages are, of course, liability. So if the business owes any money, any loans, then your personal assets becomes the collateral under which those items are loaned to you. So you do have liability that extends to your personal asset. As a sole proprietor, you do file on your personal tax return, and so you have and can have the potential for a high tax rate, which is as maximum at 33% of your income. And if the owner dies, unfortunately, the business ends. Okay, so that is the what. So for a sole proprietor, if you're in a partnership, on the other hand, some advantages towards that is you have an extra set of hands. So somebody else helping you, you have less of a financial burden because obviously 2 incomes are better than 1. And, you have the benefit of an additional knowledge, right? Somebody else, yourself, you both plan, put together, and obviously you do have that benefit. Some disadvantages, though, being in a partnership is, of course, there are chances of disagreement and conflict between partners, um, and that has to be managed, of course. Profits are split, so instead of you getting 100%, it's probably 50-50 or whatever the split may be. And of course, we still have what we call unlimited liability for the partners. And this is where, again, if there are, loans or any credits outstanding, any liabilities outstanding, then it will extend to the partners. It's not limited to the business. And lastly, we have a corporation. And corporation is one of those ones where, most people will have the corporation in order to have that lower tax rate structure. And so you get that low tax rate structure in a corporation because it files its own taxes. It's identified as an entity on its own. So it's filed separately than that of your personal taxes. And so therefore, there are other tax breaks that are available, including small business deductions and a lot more that is available for a corporation. There you have the access of limited liability. Now, limited liability is something that will extend or grow as the corporation grows. Usually for a corporation, if you're in the early stages of the corporation, the liability will extend still to the owner, unfortunately, because it needs to grow and develop and build its own assets. And over time, as it grows and retains more income and builds its own assets, then it will be in a position to borrow, lend money, and in the sense of borrowing money, it then becomes its own liability instead of extending to the owners or the shareholders of the corporation. And another pro of this of the corporation is that lenders, creditors tend to find it a little bit easier to access or to give capital to a corporation than that of a sole proprietor or partnership. Again, because of the idea that it has what we call a going concern. A going concern meaning that if the owners were just so happen to pass away, the corporation will continue to operate. And so it's usually an easier access to lend capital to on that end. But of course, they have disadvantages for the corporation. It's expensive to start. To get their corporation going, you do have the standard government fees, but whoever is carrying the corporation or getting it up for you, their fees. And so it is expensive to start. You do have the possibility of double taxation. Again, you making a salary and then, the salary gets taxed on your personal income. The salary that is paid out to from the corporation comes from account. Well, it's not from after-tax income, but it's income that is taxed. And then obviously when you do your personal taxes, it gets taxed. And there are ways around this. But again, there's that possibility of double taxation. And of course, again, being a corporation, it's a legal entity. There are more restrictive rules and legalities around the corporation. So there's more management, there's more structure and rules that one needs to follow in that sense. And so hopefully this gives you a sense of the types of businesses that we operate under. Now that we're in business, now what? What happens from here? Well, the first thing that we need to do now that we're in business is, I would say, get yourself an accounting software. As simple as it is, it's very, very important. This is one of the things that most businesses often do last, or when they're in the midst of high growth rates, they realize they can't manage and keep up with their records, and not sure how much they're spending and not sure how much they're getting. So get that accounting software because first of all, it saves you time, right? It saves you time, meaning that you're able to retrieve data. If you're looking up something, it's easier and faster. You can find information that you need to respond to, especially when it comes to your creditors. Data accuracy, very, very important because most of these software, they have double entry. It has your, when data is inputted into these systems, they need to balance, the taxes need to balance. So all that relates to data accuracy. And of course, you have the ability to upload receipts and invoices. And so you have that data accuracy to back up the data that's there. So it saves all your financial data in one place. Another important thing is that it makes you audit ready, right? We don't want to be audited. We don't want to be caught being audited and don't have documentation. Because when that happens, guess what? You will have to retrieve reports, actual receipts. Where are they going to be in your software? And if you're not ready, you can definitely owe penalties, interest, and a lot of money. And it saves you a lot of headache. Having access to reports that you need that are being on demand and asked for, it saves you a lot of headache. Okay. And again, getting that accounting software gives you insight, right? Get those financial reports to assess the health of your business, make those financial strategic decisions to have your business be successful. And lastly, it streamlines your taxes, right? When it comes to taxes, what you need to have ready are your financial statements, which can easily be prepared or printed off from your accounting system. And it not only saves you time, but the accuracy is there. It will reduce your costs when it comes to your accountants because they have what they need. You won't be having to, adding numbers here and there, working with spreadsheets. And so it streamlines this process for you and saves you money in the end.
Sandra, we have a question. I'm just going to read it out for you.
Sure.
There's two actually. The first one, is it necessary to have paper receipts if all your purchases are being done through your bank account and you have an accounting software to take notes?
Yes, it is necessary to keep these receipts because, and I'm going to go through that at a later part of my presentation. But yes, because when it comes to audit, CRA does not look at bank statements for proof. Bank statements and credit reports, visa statements are not what they're going to be asking for. They're actually going to be looking for actual receipts. So they need to be available, they need to be kept. And the good news is that accounting softwares now have the ability for you to upload these receipts. So they're there in the system. Or you could have one of those cloud software storage systems that are out there. HubDoc was one of them that I was using. Receipt Bank is one of them. And they have a couple of them. You can look at some apps on your phone that keep these receipts for you. Okay. Hopefully that answers your question.
Awesome. We got a yes. The second question was going to be exactly what I think you just answered partially. It was, do you have any recommended softwares that are possibly beginners friendly that you'd like to share with the group?
Okay, yeah, sure. So there are apps on your phone actually. Actually gonna quickly check. I do have an app that I use. Well, QuickBooks is one of them. Another one, it's called Expense Receipt. Another one is called Receipt Bank. So you just have to download like put in your phone, depending on what phone you have, whether it's Android or Apple, and just say receipts, savers, or expense receipts, and then you will have those apps that can come up. For receipt is another one. FOR ECEIPT is another one. Yeah, it's easy to find. There are lots of them out there that you could use. Okay. All right. Now, straight on to what you just mentioned, your books and your records, right? Perfect timing for that question here, because it's important. Generally, it's important to keep your records for 6 years. You must ask CRA for permission to destroy them before the 6-year mark. So it's crucial you keep those financial statements, tax returns, journals, whether they be electronic or on paper. All of them needs to be kept because they can be demanded or asked for within that time frame. When it comes to reporting your revenues, you want to indicate, whether it be on paper or in your accounting software, the amount received, including HST, right? The date you received that money, the name of the customer, and you also want to attach the supporting document, whether it be the invoices or the receipts, and so on. When it comes to expenses, you want to make sure you have an invoice that shows the date, the name of the supplier, and a description of what was bought, and the vendor's GST or HST number. Okay, all of those need to be present so that you're able to obviously record and document them in your accounting software. And also too, these are the information that CRA looks for. They look for the name of the supplier or the name of the vendor, of the customer. They look at dates, they look at the GST number, and things like that when it comes to audit. All right, so now we're going to get into the tax loopholes. I'm going to move on from here. So hopefully that general information about business will give you an idea of what it takes to, have your books organized and, be ready and have good books. All right. So the first tax loophole that I want to highlight you to is the one that's called advances and deposit. A lot of us, when we're in business, depending on what kind of business you're in, of course, you get money. And sometimes we get them in advance of the work being done. And so you get all of this money up front, and of course they become part of your income because it's money received, and you have to document it as such. Obviously, when you have that, then obviously your income is going to go up, and then you're in a higher tax bracket, and also you pay taxes on that money received. So one of the good news that a lot of people need to be aware of is that you may deduct what you call a reserve, which is an amount that exactly matches the amount that you receive in advance to reduce that money that you receive. And so it then becomes added back in income the next year for when you provide that service. And so it eliminates you paying that higher tax amount based on the income you receive, right? So keep in mind, if you receive money ahead of time, you can deduct this reserve and have that where you're not paying that high tax amount. Another one is we have home offices, right? And I alerted to this in my prior two presentations. Have that home office and write off as much as you can. You can deduct things like your rent, your mortgage interest if you own your home, the property tax, the repairs and maintenance, insurance, utilities. The deduction is calculated in terms of the amount of the space in the home that is dedicated to business use. Now, the thing about this kind of expense is that expenses cannot exceed your business income for the year. So unused expenses are carried forward to the next year. So if your income is already below zero, so you're operating as a loss, then these expenses, the business use of home expenses, cannot be used to reduce your income any further. They will only be used in the following year against other business income. And so that's the beauty of these ones. You could carry them forward to future years. I think it's up to 5 years. You could carry these ones over. Okay. Life insurance premiums. This is a biggie. Generally, life insurance are personal expenses, really. You know, you pay for your insurance for other things that you have going on, but you can have it written off as a business expense, especially when it comes to borrowing money for your business. If it becomes a condition of borrowing money in your business, then it's deductible, right? So a lot of us, you know, when we go and get a business loan or small loans or whatever the case may be, there are usually a portion of these agreements that have an insurance part of it. And so rather than, you know, using the loan's insurance policy, use your own personal insurance as collateral and deduct your personal life insurance, right? That's an additional expense that can reduce your taxes payable. Meals and entertainment. There are some insights to this one, which I don't think a lot of people know about. Generally, for meals and entertainment, one can deduct 50% of the cost of meals, beverages, any tickets, and similar items. However, if you have a business that takes you out to remote work sites, you know, more than 40 kilometers, I would say, from your regular place of business, then if you buy a meal, then the cost of those meals are fully deductible, 100%. Isn't that amazing? Or if you go out to a temporary work site, you know, like somewhere, maybe once in a while or a camp somewhere, well, the cost of those meals are deductible for your employees that end up going out to those temporary work sites. In addition, if you host special events for your employees, now this is a biggie, because not a lot of people know this one. If you host special events for your employees, you could hold up to a maximum of 6 a year. The meals are 100% deductible. Okay, so that's amazing, right? Considering generally it's 50% when you take out a potential customer and, you know, you try to win that customer over, you take them out for a meal, the 50% applies, but there are other occasions where it is fully deducted. And especially the one with the employees, take advantage of that, because that's a great one to deduct your liability. Deduct your taxes payable.
We have a question here, Sandra.
Here.
I'll just read it out. It says, is the 40-kilometer a return trip or a one-way?
It's go and come. I'm not 100% sure. I just know that it's 40 kilometers. I would think it is the 40 kilometers to go there, because that's the distance under which you need to be as far away from. So, you know, you can't say, okay, 20 kilometers to and then 20 kilometers back. It needs to be no less than 40. You get what I'm saying? So, yeah. Hopefully that answers your question. Okay. All right. Going forward, thank you for your questions, by the way, and keep them coming. Another one that's also a biggie, and I alerted to this one, is the automobile expenses. Okay, so this occurs when you use your personal car for business purposes. What you are to do is keep a log of your kilometers that you drive for both business and for personal. And how you do that is you will document your business trips with the dates and destinations and purposes and the total kilometers. And you could easily do that with an app on your phone. QuickBooks has one. Um, I don't know a lot of them off the top of my head. Again, you could just, go onto your app on your phone and identify kilometer or mileage apps, and a lot of them will pop up, and you choose one, get familiar with it. And again, when you're going on those business trips, then of course you can, document those kilometers. One of the things I encourage everyone to do is at the beginning of the year, you record your odometer reading. And at the end of the year, you record your odometer reading. And the difference between the two would be your total kilometers driven for the year. And so you would need that as part of your calculation for automobile expense. And if you change your vehicles during the year, you want to record the odometer reading at that point as well. In line with the automobile expenses, again, when you're deducting income, deducting expenses from automobile from income, it's done on a proration to kilometers driven for business purposes to kilometers driven for the whole year. So based on that proportion, then you're able to deduct what you call your license and registration fees, fuel and oil costs, insurance, maintenance and repairs, interest expenses, leasing costs, and electricity for zero emission vehicles. Okay? So these are the types of expenses that one can record as business expenses to deduct against your income when you use your motor vehicle for business purposes. Now, the next one, another tax loophole, and this is a very big one. And again, most of the time, most people don't know this. It's generally your accountant who would actually be the one to tell you this. So keep this in mind. We have what we call depreciation or capital cost allowance. And the background behind this is that, because COVID, the CRA has come out with some strategies to assist business owners to reduce their taxes payable. And one of the biggest strategies that they came out with was the capital cost allowance, which I will dive into right now. So first of all, what is depreciation? Well, instead of expensing the purchase of major assets like buildings, equipment, vehicles, and furniture, these are some things that you would buy inside of your business. Anything that costs over $2,000 is a capital expense. So that $2,000 mark is like is a defining amount that if you bought an asset or equipment or anything like that that costs over $2,000, then we need to capitalize. Now, capitalization goes in a little bit further, but depreciation is the wear and tear from usage of those items.
47.
Sorry, I thought that was someone. Sorry, depreciation is the wear and tear from usage over the years of an asset that is deducted from income. Okay, so that's what depreciation is. It's a non-cash expense. So this is something you really want to take advantage of, right? You don't have to spend money to take this advantage of this expense. So this is a big tax loophole. And your accountants, they would know about this. And there are different methods to calculate the depreciation, like declining balance, the straight line method, the double declining balance. And there's a lot more. And your accountant, as I said, will know these things. However, when it comes to CRA, they only have one method, which is called capital cost allowance. And this is the depreciation that is used by the Canada Revenue Agency. Accountants use a different one, different ones, CRA use a different one. And so there is that difference. And what a lot of accountants do, including myself, would be to just use the declining balance because that's what the CCA rate or CCA is. The difference is with CCA is that there are classes that are specific to different types of property. So CRA groups different assets by different classes. And the rates in the classes range from as low as 4% to as high as 100% depreciation. So say if you have office furniture, office equipment, or different kinds of equipment, generally those would be a class 8, and their depreciation rate is 20%. You have your automobile, which is a class 10 or class 10.1, depending on if it's over $30,000. And again, they have the different depreciation rate of 30%. And there are some of them that are in this accelerated depreciation class of 100%. Things like your computer, for example, is one of them. Usually you write off a computer right away when you purchase it, even if it's as much as $3,000 or $4,000. And that's because of the kind of asset it is. It goes, its lifespan is very short, meaning that there are new innovations, updates when it comes to computers. So those tend to be written off immediately. And so based on this, there are some strategies that one can use when it comes to your capital cost allowance. So if your income is low in the current year, or you have a loss, then it's advisable to deduct less or none of the CCA that's available to you. And then when you have a year, when you have income or highest income or more income, then you can deduct the CCA at that point. So that's a strategy that, you know, one needs to be aware of so that you can maximize your tax deduction, right? Another one would be to acquire your capital assets at the end of the year. So long as you're purchased in the year and they are available for use, you can claim CCA, okay, which is, depending on the rule, 50% of that.
So we have a question here, and it says, what about a vehicle purchase and used specifically for the business?
If the vehicle purchase is in your name and it's used for business purposes, you will still have to do the calculation as I instructed earlier. It will not be recorded as an asset until it's transferred into the business name. Now, when it's transferred into the business name, for example, it becomes an asset on the books. And then those calculations that I spoke about, like, you know, oil and gas and, you know, insurance and all of that, we will stop that and then depreciate it based on what I'm about to speak about here. It will then be in a class 10 or a class 10.1, and it will be then depreciated at 30% per year. Hopefully that answers your question. Okay, so continuing on in the space of the capital cost allowance, generally, when new property comes available for use, generally, we use what we call the half-year rule to apply only 50% of the rate for any of the class. So say, for example, a class 8, as I mentioned, is at 20%. Then in the first year when you buy it, CRA only allows you to claim 10%. Okay, and again, this is where that 50% rule applies in addition to new bought assets. There are certain exceptions, of course, to certain classes, which are, as I mentioned, are deducted at 100%. Now, as I mentioned, because COVID came in, the government instilled two very, very important, I guess I would say, tax loopholes that your accountant and yourself need to be aware of. And the first one is called the accelerated investment incentive. So what that is new property that is acquired on or after November 1st, 2018, and is available for use is not subject to the half-year rule. This half-year rule that I mentioned earlier, generally that's what it would be. So if you buy property from 2018 onwards, you're not subject to this half-year rule. And eligible property that is available for use prior to 2024 has an augmented rate of 1.5 times the rate of that class. So for example, if that 20% that I mentioned earlier for class 8, you know, say that class 8, I bought it, what I would do generally is take half of that. So I would only be able to write off 10%. But now with this accelerated investment incentive, I'm now able to not only write off that 20% because the 50% rule no longer applies. And again, 1.5 times that 20%, which will now be 30%. So instead of the 20%, I'm able to write off 30% of that asset in its first year. So that's what this is, and it's called the accelerated investment incentive. It does not change the total amount that you can deduct over the life of the property. But what it does is by claiming a larger deduction in the first year, you will have smaller CCA deductions in future years. But the idea is during around the COVID, you know, go back as far as 2018 to 2024, the government instilled this incentive to help small businesses recoup and reduce their taxes payable. Another one that they have instilled is one called the immediate expensing. According to the 2021 federal budget, the federal budget proposes to permit, you know, Canadian controlled private corporations, that's what they call CCPCs, to expense as incurred the cost of eligible property that is acquired on or after April 19th, 2021, and that has become available for use prior to January 1st, 2024. So what does that mean? The maximum amount that is eligible for immediate deduction is 1.5 million per taxation year. So to put it in layman's terms, what this means is that any asset that you buy, doesn't matter what class it is, you're able to write it off up to a maximum of 1.5 million that you have. So if you bought a car and you know you bought a property or you bought a big machinery, you're not restricted by the half-year rule or, you know, okay, well, I can't, you know, because the wear and tear. You could immediately deduct it so long as you're within that $1.5 million. It's only available on some properties, but the idea is this is an incentive that can reduce taxes payable by a lot. And again, these ones came out due to COVID to help small business owners and businesses in general to recoup and to reduce their taxes liability. Okay. The main thing is that your assets, when you buy them, they have to be available for use. You cannot buy them and say, okay, well, I bought them. Okay, I'm going to get it. No, you know, you can't have them and have them sit in storage or something like that. They have to be available for use, like you're going to be using them or are using them inside of your business. All right. Next one is called the shareholder loans. What is this one? Okay, this is when the shareholder receives income from their corporation. Now, generally, we could take money out as drawings from our corporation. And of course, when you take the drawings out, it then you'll then record that as income on your personal tax return. But this is the loophole that we don't know about. You and I, as shareholders of our corporation, can take out loans out of our company, and we don't have to record that. Don't have to record it until after the end of the taxation year. let's look into this one a little bit deeper. So loans to shareholders must be repaid within 1 year after the end of the lender's taxation year in which the loan was made, in order to prevent the loan from being included in the shareholder's income the year the loan was made. So for example, I took a loan out of my company in June 2023, June 15th. My company year end is December 31st, 2023. When I took out that money, I don't need to record it as income and get taxed on it. The date on which I need to repay it would be December 31st, 2024, 1 year after my year-end business date, my business year-end date. So that is money that you could have without paying taxes, okay? And if you pay it back before the December 31st, 2024 date, as in this example, then guess what? You don't need to record it as income. And you have that money tax-free. So if you need some cash, this is what a lot of business owners do. They record it as a loan. It's legal, and of course you need to repay it. But if you repay it beforehand, then you're not obligated to record it as income for personal. Next one is the automobile allowance. Okay, this is a biggie, and I think I mentioned this one before, but I'll dig in deeper a little bit in this one. So if you use your car for business purposes and you've set yourself up as an employee for your corporation, then what you can do is, and for your employees, so they use their own car for business purposes, and you can do this thing called the automobile allowance. So you can give them an allowance for up to 70 cents per kilometer for the first 5,000 kilometers, and then 64 cents per kilometer driven after that. And so they get this allowance, and then you get to write this off as a business expense. So if an employer or your corporation pays you for business use of your car, and if the amount is reasonable, okay, reasonable means it's within this rate of 70 cents per kilometer for the first 5,000 kilometers and 64 cents per kilometer driven after that. That's what reasonability means. The allowance is paid as part of the employee's salary and is not part of their taxable income. So they get this money tax-free. Or you, if you're an employee of your corporation, get this money tax-free. The allowance will be considered reasonable and deducted as a business expense since it's directly related to the number of business kilometers driven in a year. So this one is a very powerful tax loophole that I hope that, most of us, we use our own personal vehicle for business. We could write this off as a business expense and reduce your taxes payable. All right, moving on. This one is called the incorporated employee. This is when the owner becomes an employee of the business. Similar to what I just alluded to just now. If you become an employee of the business as the owner, obviously there are some benefits for that. One, salary is deducted as an expense from your business. And having a payroll account serves as a qualifier for government funding and grants. Remember when the CEBA loan came out and the Canada Emergency Wage Subsidy came out? The qualifier was that you had a payroll account. If you had that payroll account, then you were immediately qualified for these loans. So why not take advantage of this opportunity? Have that payroll account. Pay yourself as automobile allowance. Put yourself in those lower tax brackets and pay less taxes and have this allowance happening. It's a great way to maintain and serve your business as well as yourself. As a business owner, you also get to manage your personal income and the taxes that you pay, which is what I just mentioned. Put yourself in a lower tax bracket, pay minimum federal taxes, CPP and EI, because there's certain tax brackets, certain tax income amounts that you don't pay, federal taxes on, right? And so you could eliminate that. So you have this control when you're a business owner. And of course, having a T4 slips, having that T4 slips adds credibility, to you having income, and it adds to income verification, especially when it comes to, purchasing a car, purchasing a home, things like that. So have yourself set up as an incorporated employee. Rent expense. I think I mentioned this one before, but I will mention it here again. Well, have your business rent from you, right? You have a corporation and you operate from home. Have your corporation rent your home for its operation and claim rent expense as a deduction for personal tax purposes, right? So, if you have a company renting from you, then guess what? You can write off rent on your personal tax. That is something most people don't know, and it reduces your tax liability on the personal side, right? So you as an individual will be able to write off home expenses, which you would have never been able to written off before. And why not take advantage of that? The business benefit to this is that the business deducts rent expense. Funds paid from business to you as the owner of your income is not being lost, it's actually just being transferred. And of course, you as the business owner can reinvest this money into the business and increase the equity of the business, or give back the equity, put back the equity in the business, right? So that's another strategy, another tax loophole that one can take advantage of. Health spending account is another one, okay? Health spending account is where you get to deduct medical expenses from business income. Well, let's say this first of all, that medical expenses is something that one generally is not able to deduct from business. Okay, that's only a deduction. That's only a deduction for personal expenses. Okay, but guess what? With the health spending account, now you can deduct medical expenses. Now, what is this health spending account? Well, in simple terms, health and dental benefits offered through this plan are 100% tax deductible to the employer and received 100% tax free by the employee. There are no premiums, no fees, deductibles, copay, or complex policies. All you need to do is speak to one of your financial advisors, ask them how to open a health spending account, and they'll tell you all about it. It's available for you. It's actually better than even your workplace health plan that they have going for you. Because when you have this, amounts are allocated for you as the owner and for your employees. And as soon as you purchase whatever medical expense you incur, then the company reimburses you, right? And gives you that money, and it records it as an expense on its own books. Okay, so that's the benefit. The personal benefit, of course, employee or the corporate individual, you're not paying any premiums, like how you regularly pay premiums from when you're employed. Okay, this is my, sorry. It removes the toughest grease and residue for irresistible. This is money that is set aside under this plan, and it's there for 100% reimbursement. Okay, so that is something to look into as well. All right, moving forward, business losses, non-capital loss, get a tax refund. Now, generally, when you file your corporate taxes, you don't get a tax refund. You end up paying taxes if you earn income, obviously, and then of course, it's not a high tax bracket, but you do pay taxes on the money that you earn. But anyway, if a business incurs a loss, it can give back this loss for 3 years and forward up to 20 years. The loss are applied to taxable income for,
Cereal, no, it's gonna make me flatulent.
or someone mute the mic of that person. Okay, I'll read that again. When a business incurs a loss, it can carry back the loss for 3 years and forward up to 20 years. The losses are applied to taxable income for the year assigning or assigned, triggering a refund for that year. So what happens is you record the losses that you incur from your business, and then in the year when you earn income and you have to pay taxes, those losses from prior year can be carried forward, and they could be applied against the taxable income in that current year. And then it can reduce your taxes payable, or, if you carry it back to those years where you paid taxes, then it can trigger a refund to you for that year. So it's very powerful that you keep in mind your business losses, because they reduce your taxes payable going forward and or trigger a refund for you from the years where you did pay tax. Bad debts. So we have all of this, right? This is when a customer defaults and not pays you the money that you deserve when you conduct your services. Well, as a business, you can fully expense a customer defaulted payment. Okay, so that's something for sure. And a bad debt can also be treated as a capital loss. And depending on what kind of loss it is. So if it's a loss from a business, a business venture, you bought a loss and the person that bought a company and the person, you sold a business and the person didn't end up paying for the business, then it becomes a bad debt. That loss you could carry back 3 years and forward for infinity, because it's now become a capital loss. And that's the beauty of the bad debt. It's fully deductible on a business side when it comes to customers not paying. But then again, when it comes to business purchase and stuff like that, it becomes a capital loss, which can then be carried back for years and forward to infinity. Okay, so it only applies to if you're unable to collect proceeds from the sale of a capital property or some sort of investment for business purposes. Now, I spoke about non-capital losses earlier, so now I'm speaking about capital losses and capital gains. Capital losses can only be applied against capital gains. So when you sell property, you will likely have a capital gain or a loss if that's the what. So again, capital losses, which are different from non-capital losses, can be deducted from capital gains, be carried back 3 years, but forward, not 20 years, to infinity. Okay, so long as you have a capital loss, it will stay with you until you have some sort of a capital gain, and then it gets deducted from that. So a strategy is, if you have a property that is losing investment, sell it before year end to realize a capital loss, and it can be offset against a capital gain. Okay, so if you have capital gain sitting there, you have something that's not working out, sell it and write off the loss against the gain and reduce your taxes payable. So that's for capital gains and capital losses. Now, another biggie is when you transfer an asset or asset transfers to a corporation. Usually this is done when you're selling your business, or when you're moving from a sole proprietor to a corporation. What normally happens is when you move from a sole proprietor to an incorporation, you need to transfer the assets to the corporation. And normally when you transfer or do something like that, there is some gains involved, there are some taxes involved. you're required to include the income from those transfers and or gains of those assets. You have to report them as income and then you could be taxed. So one of the things that one can do to defer this taxation is to elect what you call Section 85 of the Income Tax Act, which is Form T 2057. This allows the asset to be transferred at an elected amount other than the fair market value. The elected amount becomes your income and the corporation cost amount of the transferred asset. So this elected amount becomes the income and the cost of the asset. So they become nil, which would then reduce the taxes payable on the income earned from transferring. Okay, so the thing about this one must include at least one share of the corporation when you're transferred the asset. But again, this is something your accountant would know. And again, if you're embarking on something like this to reduce your taxes payable, ask about P 2057 or Section 85 of the Income Tax Act. And selling your business. This is another one. A lot of us, in fact, I was dealing with a client of mine last week. She's in this process of selling her business. And, one of the things I reminded her of was to, convert her assets into what we call shares. Your lawyer should be able to do this. So whenever you're selling your business, convert your assets to what we call shares. Because as Canadian residents, shareholders are eligible to claim what we call a lifetime capital gains exemption on the sale of shares of a small business corporation. The lifetime capital gains exemption limit for 2024 is 1.25 million, and this will become effective in June 25th, 2024. This means half of the gain is taxable, therefore you get $625,000 tax-free. So if you're selling your business and your business that you're selling it for is $150,000, just say, then guess what? You won't be taxed on it because your half of the gain that you get tax-free for the lifetime capital gains exemption is $625,000. So that 150,000 gets reduces that 625,000 maximum that you have, okay, for being tax free. So again, a lawyer would be able to set this up, and when the sale and the transaction goes through and taxes need to be paid, the lifetime capital gains exemption is something that you can, what they should come up with, or now that you're familiar with it, to mention and take part of this exemption, because it's money sitting on the table for you and I. That's why it's called lifetime capital gains exemption.
I have a question.
Yes.
So what happens in the case where when you're transferring your business assets from a sole proprietorship into a corporation in terms of the expiration? Because a sole proprietorship expires and can't be renewed, but a corporation can. So is the sole proprietorship still going to do its time until it expires, or is it advised that you do it when it expires? What happens there?
So when a sole proprietor, I wouldn't use the term expires, and I do get the idea that, it has that 5-year turnaround when you register it. But when you're transferring or moving from a sole proprietor to a corporation, the tax authorities, the CRA, will allow you to do the transfer and allow you to carry on that business, but within a reasonable time frame to exit, or what we call close down the small business. So there is a time frame in there. They call it a reasonable time frame where you could have both happening, but the expectation is that obviously you close down the small business. So there's no, I guess, by 60 days later or 30 days later, there isn't anything like that. But the idea is within a reasonable time, I would say a month or two later, so long as when the transfer is fully done, you can still have it, and then eventually you need to close it. Okay,
Thank you.
there you are. Now, what are the consequences for not filing your taxes on time? This is something I want to delve into. We all need to make sure. We just passed the April 30th deadline, right? CRA will be charging you a late penalty if it's not done, especially when you owe money. They will garnish your wages, which means that they will take a portion of your income to pay off outstanding debt. If you've got your collection warnings, if you've got letters saying, please file, please file, please file. They may freeze your bank account and seize assets like your home. That's how serious it can get. I have several clients who have been in this space and are in this space right now. I have one client who, they froze all of his bank account. Any bank account that he opens is frozen. They're taking money out of his paycheck because now he had to stop his business. And he, because of it, was so distraught by all of that, he ended up in the hospital and was just recently released home, just trying to recuperate because of all of this that took place for him. He had to be borrowing money to pay money, right? I did his taxes for him, of course, didn't charge him right now because he's not able to pay me because of all that. So you want to be, ready, be able to make sure that you file your taxes on time. And if you are not a Canadian citizen or a resident, you may be deported. That's how bad it is. And finally, if you're convicted of tax evasion, you may face a prison sentence. That is possible as well. What are these penalties and interests that will happen when you don't file your taxes? Well, the penalty is 5% of your current year balance owing. So whatever it is that you owe, for everyone it's different. 5% of that is what it will start with, plus a 1% of the balance owing for each full month that your return is late, to a maximum of 12 months, and it keeps going, right? So your late filing penalty may be higher if you were charged a late filing penalty in previous years, so it compounds, right? So we want to make sure that if you are behind, you make sure you pay, because not only are you facing these penalties, but there are some tax benefit that gets, they become old and then you're not, they're not available anymore. So I think it's a 3-year time frame. So within the 3 years, if you don't file your taxes, some of the benefits come obsolete. You don't get the benefits. Okay? So the deadline to file taxes for businesses is June 17th. So that's coming up next month. Bear that in mind, and hopefully you'll be ready for that. Garnishment. What is this garnishment that I spoke about? Occurs after several collection notices. Once the notice has been issued, CRA now has the power to take payments directly from your wages, up to 50% if you're employed, and up to 100% if you're self-employed. I want to embark again on that. 100% of your income if you're self-employed. Make sure you file those taxes. Any money you have in your bank account can and will be seized. Your assets will be seized to pay your tax debt. And, as I said, that is real and it's there. Impact. Consistent accounting and bookkeeping is what you need to have the maximum growth. Okay? Be organized. That's the main thing. Books and records will be organized and easy to be prepared. Less worry when your books are organized. Be confident in your records. Be qualified for loans. Claim those benefits. Be qualified and claim those benefits you're entitled to. Be grant ready. Those are some benefits. COVID-19 grants, remember those required companies have, business bank accounts and payroll bank. Have your books ready, in order so that you'll be able to monitor your progress and increase the likelihood of being a success in business. And that's it. This is me, allgoodaccounting.com. I'm here to answer any questions that you have. This is my contact information. I provide accounting bookkeeping services. I provide set you up with QuickBooks. I do your taxes, payroll. I train you. I provide creative alternative accounting and tax solutions guaranteed to save you money. And that's the end of my presentation. I hope that I was able to enlighten all of you and give you some tips and knowledge to take your business further in its journey. Thank you for this time.
And just before you close out, we have a question. And here it says, one question I receive a lot from new businesses is, should they set up their HST number considering they earn under 30,000? I have an answer for that as well.
Yes, absolutely. I recommend, as soon as you're getting business, to open that HST account, because what it does is it allows you to claim back those expenses in the early stage of business that you wouldn't get back. Because usually when you start business in the early stages, you're at a loss anyway. So why not get back some of that money that you're entitled to? You don't need to wait, and I don't recommend you waiting for that 30,000 threshold that they have, for you to be mandatory to open such an account. I would say go ahead and open it and take advantage of it.
Alrighty. If we do not have any other questions, gotta thank you. I'll give the floor one more opportunity to give questions. If anyone has any questions, you can come off of mute right now, or you can throw it in the chat. Give you about just a few minutes. And I don't see anything, so I am going to say, oh, Barry, you're off.
Yeah, I think it's a question. Okay, my main problem is that I am an independent contractor and I have a couple of set up corporations, and it starts to get confusing to what you would file taxes for as an independent contractor, what should be put under the corporation, and what should be, and what and how you should be claiming taxes personally. So are there any thoughts about that, so it's not all confusing, and maybe the best strategies on what income to claim where?
Yeah, absolutely. To be honest with you, when people come to me per se, I go through a very detailed analysis with you. I share with you a worksheet that allows you to look at and look at all the revenues and expenses that one is allowed to claim. And based on that, I give you the advice and direct you as to what you are to do. So it would take me meeting you to show you what those are, but definitely it's something I could help you with. It ranges anywhere from, meals and entertainment, advertising, all the way down to convention expenses, training expenses. The list goes on and on and on, but it's where somebody like myself will give you that knowledge and help you to organize and making sure that you know how to keep a record of those going forward so that you're able to maximize those deductions.
And I'd also probably like to add, it's probably a little more clarity for you because I was in that position as well as a business consultant. And maybe it'll help you feel a bit better if you know that, sorry, I'm just gonna admit someone here. even though your expenses are sometimes mixed, you have something, because you registered as a corporation, you have something called dividends. So when you have that accountant that steps in, they'll be able to go through, and when they separate what she was making reference to in those different categories, you'll be able to let her know, okay, maybe there was a business purchase through my personal that we'll have to make a difference for, and maybe vice versa. So it's just all about keeping track, like she said. When you keep track, you have your receipts, and you use your bank statements to be able to say, yeah, there was a business purchase on the personal, or vice versa, you'll be able to work it out through your dividends as well.
Awesome. Good perspective. Appreciate that.
No problem.
Uh,
Does anyone else have any questions? I see Juliet came off mute. Nobody else? Okay, Sandria, could I just ask that one more time you just share your screen with your contact information? We just had someone in the chat requesting that.
Okay, sure.
In the meantime, if there are any questions, I open the floor once again.
Well, I'm not going to be shy. So when qualifying for a loan, let's say, for example, a mortgage, it's understanding sometimes that, like, people, let's say they qualify for mortgage and they want to be able to qualify for as large of a mortgage as possible. So you get people thinking that they should be showing more income, especially if they're self-employed. Should they claim more income or show more income on their notice of assessments in order to get a more favorable interest rate? And I always think that that doesn't make sense, because you're going to be paying more in taxes probably than to save on your monthly payments on your mortgage. So my question is, are there other strategies to show your income that doesn't have to be shown on your notice of assessment in order to qualify for things like loans or mortgages?
Yeah, sure. So in that instance, it depends on the mortgagor, or the institution where you go to get the financing for your mortgage, so to speak. I know that there are some of them, depending on the type of lenders that they would only use something like, they don't ask for your bank, your financial statement. They ask for your bank account. And so they could prove that the money is in the bank account, and they use the gross, not the net. So yeah, you have money going in and money out. And if they could tally all the money coming in, they will use the gross, and that determines your income. And under that structure, you then can be qualified. So it all depends on the mortgager. But yes, that is one way to go around it. I won't say to inflate anything to make it look a certain way. Find out which lender would require you not to have that because they're there, and then go forward.
And just a side note to add to that, if that is the option you're probably taking, it's good to keep in mind that you have personal lenders, also known as your private lenders, and then you have your public lenders, which are your big banks. And big banks usually use applications that want to verify your bank account through sign-in. So most likely they're validating how much you're really making based on what's depositing into the account, rather than with your private lenders, you're actually having to admit more information, because they're usually C lenders or B lenders that have to do with a lot of trustworthiness when it comes to that. So when they require more documentation, they may not validate through the same source as an A lender, which is your public source, but they may want to validate through employment letters and all that kind of stuff that also contribute to that factor. So just keep that in mind as well, what kind of lender you're using, so you understand what way you need to really go about it. Awesome. Anybody else? Dope, dope, dope. So once again, thank you, Sandria. This was an awesome session. I learned a lot myself. I love learning more.